Ladies and gentlemen, good afternoon.
Men are waking up tomorrow to realize that the price of silver has moved not by a fraction of a percent, but by several at ripple felt across markets worldwide. That is not fantasy. It is what could happen within 24 hours. And frankly, I believe we are standing on the edge of such a shock when we talk about markets, particular precious metals like silver. It's very easy to get caught up in the surface level moves, the price ticking up, the volatility, the sentiment and the headlines. But what really drives these shifts, not just the immediate buying and selling, but the underlying mechanics of debt and monetary dynamics. That's where the story begins, and that's where the next big moves will come from. If you step back and look at history, you'll see repeating patterns. Every society builds up debt, what always feels manageable at first. Debt allows governments, companies, and individuals to live a little bit beyond their means. At first, that's stimulative. It fuels growth. It creates a sense of prosperity, and it often prolongs cycles that otherwise would have slowed down earlier. But then over time, debt becomes a trap. Interest payments rise, obligations mount, and the system grows fragile. Once it passes a certain threshold, policymakers face an impossible dilemma. Either allow defaults and contractions or print more money to paper over the problem. That is where monetary dynamics collide with debt realities. And now think about silver in that context. Silver, like gold, has always been more than just a shiny metal. It has served historically as a store of value when paper money was debased, when trust and institutions wavered, or when inflation began disputing purchasing power. When governments lean on monetary expansion and relieve debt burdens, they are essentially devaluing the currency, whether they admit it or not. When that happens, rational actors look for something real, something that cannot be printed, cannot be manipulated by decree, and cannot be fought. That's why silver becomes so relevant in these moments. We are already living in such an environment. Global debt has reached levels that were unthinkable a generation ago. Governments are running structural deficits year after year, and central banks have stepped in not only as lenders of last resort, but in many cases as permanent buyers of sovereign debt. Call it quantitative easing or liquidity support, but in practice it means creating money out of thin air to meet obligations that would otherwise be impossible to cover. That dynamic directly impacts silver because it diminishes faith in fiat currencies. If you cannot trust the value of what's in your pocket or in your bank account, you begin looking
Elsewhere.
History is very clear on this. Whether it was the debasement of the Roman denarius, the overprinting of continental dollars, or the inflationary episodes of the 20th century, people shifted to hard assets when paper was compromised, silver being more accessible than gold, and having industrial uses as well often became the metal of choice for ordinary people and investors alike. The dual nature of silver makes it even more reactive. It responds not only to monetary distrust, but also to real economic demand. That combination is explosive when debt and monetary imbalances converge. We are now in a moment where the cycle is turning. Debt service burdens are straining economies. Inflation has already shown its teeth, even after policymakers tried to dismiss it as transitory. Central banks are starting to cannot raise rates too high without crushing growth and triggering debt crisis, yet they cannot keep rates low forever without fueling inflationary pressures. This tight rock is inherently unstable. When instability appears, the adjustment often comes suddenly and violently. That's why within a 24-hour window, you can see shocks in silver prices that look almost irrational. If you only focus on the surface, but if you understand the underlying debt and monetary dynamics, you see that they are not irrational at all. They are the natural result of accumulated pressures finally breaking. One of the principles I've learned is that markets are like a weighing machine in the long run, but like a voting machine in the short run. In the long run, fundamentals prevail. In the short run, it's psychology, fear, and positioning. When debt is high and currencies are being diluted, long-term fundamentals for silver are strong. When a specific event triggers fear, whether that's a policy announcement, a sudden liquidity injection, or a geopolitical shock, the short-term psychology aligns with those fundamentals. That's when you see outsides move. And once a critical mass of participants realizes what is happening, the move accelerates. What we're likely to see ahead is not a gradual quarterly adjustment, but a more abrupt realization. Debt and monetary dynamics don't change smoothly. They shift in phases for long periods. Nothing happens and then suddenly everything happens at once. When you combine the relentless buildup of obligations with the blunt tools, that monetary policy, the outcome is volatility in places where trust is scarce. Silver thrives in that kind of volatility because it is both an asset of last resort and a reflection of economic stress. So as we look at the immediate future, remember this. The moves that shock markets are rarely random. They are the visible tip of deeper invisible forces. Forces tied to how we borrow, how we spend, and how we create money to cover gaps. Silver's next 24 hours may surprise many, but if you've been paying attention to debt and monetary dynamics, it should not surprise you at all. It is simply the unfolding of a cycle that has played out countless times before and will play out again. There are moments in the arc of financial history when people are forced to confront a very old truth. Trust is fragile. Trust in money, trust in governments, trust in institutions. All of it can erode much faster than most expect. And when that erosion begins, people instinctively move toward assets that feel safe, that are not dependent on promises, and that have endured through centuries of upheaval. That is where silver comes into focus because its role is not just industrial or decorative. It has always been about preserving value when the structures around it weaken. If you think about the present environment, what stands out is a growing sense of uncertainty. We have rising frictions from trade disputes to outright conflicts. We have economies weighed down by debt that is being rolled over rather than resolved. And we have monetary systems stretched by repeated injections of liquidity, each one leaving behind a residue of distrust. In such conditions, it is natural for people to seek something that is not mercy of political or financial decisions. Silver represents precisely that. What makes silver unique compared to many other assets is its dual character. On the one hand, it is an industrial commodity with applications in technology, energy, and manufacturing. On the other, it has historically served as money as a tangible store of value. Combination creates an unusual dynamic. When economies are growing and industries are demanding more raw materials, silver benefits from that demand. But when growth falters or when inflation eats away at purchasing power, silver also benefits as a safe haven. Few assets carry that dual engine. We are entering a period where this nature will matter even more. For decades, fiat currencies have dominated because people trusted them. They believed central banks could maintain stability and governments could manage their debts. But as that confidence weakens, the search for alternatives intensifies. Gold has always been one such alternative, but silver, with its lower entry point and its broader base of utility, becomes especially appealing to a wider population. It is the people's metal in many respects. It's accessible, practical, and yet historically powerful as a store of value. But people rush to safe havens. The moves are rarely gradual. They come in waves triggered by shocks, a sudden policy reversal, an unexpected crisis, or a flare-up in global tensions can shift sentiment overnight. In those moments, the reassertion silver as a safe haven is not an abstract idea. It's visible in prices, in volumes, and in the sheer urgency with which investors reposition themselves. Markets that seem stable suddenly feel fragile, and assets that seemed out the favor suddenly become indispensable. What many fail to appreciate is that this process is not driven only by retail investors or individuals hedging their risks. Institutions to reallocate when trusting in readers, large pools of capital, often restricted in what they can hold, begin to reconsider allocations when currencies decline through credibility or when bonds no longer provide security. That institutional shift amplifies the movement. Silver, being more thinly traded than some larger markets, reacts with even sharper volatility when such flows occur. This is not just theory. It has played out repeatedly across history. During periods of monetary stress, silver has consistently surged. 1970s, as inflation spiraled and confidence in the dollar weakened, silver multiplied in price. In the aftermath of the financial crisis, as liquidity injections raised doubts about the stability of the system, silver once again rallied sharply. The context changes, but the pattern remains the same. When safe and demand reasserts itself, silver becomes beneficiary in ways that surprise those who are not paying attention. The current moment is shaping up to be another of those turning points. Inflation is not fully under control. Debt is not being reduced. It is being rolled forward with greater and greater dependence on central bank intervention. Geopolitical risks are not easing. They are proliferating. These are precisely the conditions in which people remember why silver matters. This moment comes not because of hyper-speculation, but because the fundamental need for safety overrides every other narrative. It's important to understand that this reassertion is not only about protection, it's also about opportunity. When trust arises, wealth doesn't disappear. It shifts. The flows of capital move from vulnerable assets into resilient ones. That shift, repeated at scale, can create powerful upward moves in prices. Silver, being smaller in market size compared to gold, is especially prone to sharp adjustments. That is both the risk and the opportunity. It reacts more dramatically when the safe haven impulse takes hold. As we look at the road ahead, it's clear that silver's role will not be a footnote. It will be central to how people respond to uncertainty. And the irony is that it often takes just a small spark to remind the world of that role. A sudden devaluation, a financial accident, or even a statement from a policymaker ignite the awareness that paper wealth is fragile. Once that awareness spreads, the reassertion of silver as a safe haven becomes not just possible, but inevitable. The lesson is simple. Cycles of trust and distrust are as old as markets themselves. Silver has been through every one of those cycles and it has survived them. The moment we are entering now is no different in essence, only in scale. And when the safe haven impulse fully returns, silver's moment will not be subtle. It will be sharp. It will be disruptive. And it will remind us all why the world has never really let go of its connection to this enduring metal. Markets are often prepared to oceans, calmed, long stretches, moving in predictable tides, and then suddenly hit by storms that seem to come out of nowhere. What most people miss is that the storms are rarely random. They are usually the result of multiple weather systems colliding, each one manageable on its own, but together producing turbulence that no one can ignore. Silver, like other real assets, reacts most dramatically when these short-term shocks converge all at once, compressing years of adjustment into a matter of hours. When you step back, it's clear that markets build pressure slowly. Investors position based on assumptions, policymakers manage expectations, and traders take comfort in patterns that feel reliable. But beneath the surface, imbalances grow. A debt load becomes unsustainable. A central bank stretches its credibility. Supply chains grow fragile and geopolitical disputes intensify. Each of these on its own is concerning but not destabilizing. What creates the real shift is when several of them align in the same window of time. Alignment doesn't just nudge markets, it jolts them. Silver is particularly sensitive to these convergences because it sits at the crossroads of multiple forces. It's an industrial metal, so it responds to disruptions in supply and demand. It's also a monetary asset, so it reacts to shifts in currencies, inflation, and interest rates. And it's accessible to institutional and retail telepits, which means sentiment can turn quickly and spread broadly. When a short-term shock hits, silver doesn't just move, it often surges because it is being pulled in multiple directions at once. Think about a scenario where a major central bank announces an unexpected policy change, say a surprise rate cut, a sudden injection of liquidity on the same day that a geopolitical conflict escalates alone. Neither of those events would move markets together. They amplify each other. The policy move signals currency weakness or future inflation. The geopolitical flare-up raises concerns about stability and global trade. Investors suddenly look for safety in it. At the same time, industrial users begin to reassess supply risk. That is when silver can make moves in 24 hours that would normally take months. History provides plenty of examples. In the 1970s, oil shocks converged with monetary instability, and silver reacted violently. During the 2008 financial crisis, the collapse of major financial institutions collided with unprecedented central bank interventions. The reaction in silver wasn't linear. It was jagged, volatile, and at times breathtaking in its speed. More recently, during the pandemic, supply chain disruptions converge with stimulus programs and investor panic, producing massive swings in a very short span of time. They are reminders that short-term shocks are never isolated. They travel in packs. The reason the market is often caught off guard is psychological. Human beings anchor themselves to recent experience. If prices have been stable, people expect stability to continue. If volatility has been low, they assume it will stay low. That's why sudden convergences feel like shocks. They shatter those assumptions all at once. Silver, because of its relatively small market size compared to other asset classes, magnifies that shock. The same flows that would cause a ripple in a trillion-dollar market can create a wave in silver. Another principle that explains these moves is the role of leverage. Modern markets run on borrowed money. Investors don't just hold assets, they hold them with leverage. When shocks converge, leverage turns from a threat into an enemy. Margin calls for sales. Liquidity dries up and price swings accelerate. In a market like silver, which already has volatility embedded in its DNA, leverage unwinding can transform a normal move into a stoic one. That is why 24 hours can sometimes feel like an entire cycle compressed. Looking at the current environment, you can see the setup for another convergence. Debt burdens are high, central banks are under pressure to manage conflicting roles, and geopolitical tensions are intensifying. On top, supply chains for key industrial metals remain vulnerable, whether due to energy transitions, labor disputes, or trade restrictions. None of these factors on their own would guarantee a major silver move. But if they begin to align, if two or three of them converge within the same short time frame, the market response will be outsized. What makes these episodes so important is not just the price movement itself, but what it reveals about the underlying system. Short-term shocks expose fragility. They show where trust is weak, where liquidity is thin, where assumptions no longer hold. In that sense, silver's sudden moves are not anomalies. They are signals. They tell us that deeper forces are at, or forces tied to cycles of debt, monetary policy, and geopolitical order. Ignoring those signals is dangerous. Interpreting them correctly can be invaluable. So when we talk about the next 24 hours, the real point is not prediction, it's preparation. No one can know the exact trigger in advance, but anyone who studies history and understands how convergence has happened can see the vulnerability. So for more than most assets reflects that vulnerability quickly and violently. That's why sudden surges should not be dismissed as random noise. They are the expression of accumulated pressures finally breaking through. And that's the nature of markets. They move gradually until they don't. They seem predictable until they shock you. And when multiple shocks converge or took decades to build, can change in a single day. Silver's role in that process is not peripheral. It is central, because in moments of rapid convergence, it becomes both a mirror of the system's fragility and a refuge from it. Times like these, what matters is not only, but how you respond. If such a shock occurs, and I believe it can, you must have anticipated the systemic cracks, diversified wisely, and positioned yourself ahead of time. Remember, cycles repeat. History shows us time and again that when debt and trust diverge dangerously, real asset markets surge, often abruptly. Silver, with its dual nature as industrial commodity and safe, have an asset, is at the heart of this potential move. So whether you listen today and adjust, or miss it and react later, that choice is yours. But the markets won't wait. The next 24 hours could chart a new course, not just for silver, but for the global financial equilibrium.